Hey, good morning, everyone. My name is Kashif Ameer. I'm Operation Manager of Joggers Ltd. I have colleagues, Mr. Suleman Raza is our Finance Manager, Shaoor Ahmed, our Human Resource Manager, and Mr. Khan is our Marketing Manager. So, first of all, I would like to discuss strategies that we adopted to achieve our goals. Joggers Limited has adopted moderate quality and moderate cost strategy focused on cost efficient production and distribution methods, increased expenditure on advertising to achieve maximum sales revenue. We use of our spare capacity for manufacturing of private label shoes to generate more revenue. All right, the next one is the overall performance of our company executive summary throughout the period. For this, I've got earning per share that increased by $1.94 compared to the last year, which is now $5.74. Return on equity increased by 7.4%, which is now 27.6% in year 13. Share price increased by $52.27 in year 13, which is a lot higher than the investors' expectation. We improved our credit rating to the maximum level of A+, which is better than an investor's expectation. We increase our image rating decreased by 3 points from last year, but it is still equal to investors' expectation of 70 points. For finance section, I will call our finance manager, Mr. Suleman Raza, to carry on.
Thanks, Mr. Kashif. Good morning, everyone. This is Suleman. Thanks for joining us, our annual shareholders meetings. I'm finance manager of Joggers Ltd. So I'll talk about our financial performance briefly, which has been very good throughout. The sale revenue increased by 30 million due to increase in prices. Expenses increased by 12 million due to more increase in revenue than expenses. Net profit increased by 17 million from year 12. Next one is about earning per share and dividend. In year 13, company made highest profit in last 3 years, which resulted in earning per share of 5.74. The management decided to increase the dividend to $30 per share in year 13 with the increase in earning per share. And there are some key financial ratios. The current ratio increased in year 13 as compared to year 12 because the current assets increased. Because the current assets are increased. The debt to asset ratio declined in year 13, which is good for the company as it has only 70 cents of debt for every dollar of assets. This is because of the management ability to meet its obligations to pay the current portion of company's long-term debts and increase in total assets. The interest coverage ratio increased in year 13 because of decrease in interest expense and increase in operating profit. The default risk ratio has inclined from 2.37 to 4.83 in year 13 because of increase in free cash flow due to net profit increase. So I'll call Mr. Kashif again. He's our operation manager in Joggers Limited.
So I'm back again. So for operations activities, first of all, I would like to discuss workers' productivity. At North America, the workers' productivity increased from 4,000 in year 10 to 5,126 in year 13. So in year 11, the work on upgrade of our North America plant to boost workers' productivity by 25% with an investment of $7 million. This upgrade has increased worker productivity in year 12 and 13. For reject rate, in year 11, the work on upgrade of production facility at Asia Pacific plant was started with an investment of $10 million. Due to this, Asia Pacific plant's reject rate reduced substantially in year 12. Year 12, that almost by 50%. In year 13, it further reduced to 3.7% due to increase in best practices training. For branded production cost, there is a slight decrease in production cost at both the plants due to upgrade of plants initiated in year 11, which resulted in increase in productivity and decrease in reject rates. For plant capacity utilization, the plant capacity at both the plants was fully utilized to 120%, which led to increased production volume and sales revenue. So the next section is human resource. I'll call Shaoor Ahmed to carry on. He's our human resource manager.
Good morning, everyone. Myself, Shaoor Ahmed. I'm a human resources manager of Joggers Ltd. First of all, thanks to all of you to be with us here in this meeting. Today I'm going to talk about human resources strategies of Joggers Ltd. To satisfy our customers and increase productivity, we are increasing 1% of base wage. We are also spending some money on different programs like Six Sigma and Total Quantity Management. In year 13, we spend about 50 cents on per pair to achieve target. We are also spending on best practices in North America. We're spending $11.50 on per worker in year 2013. Best practices not only to reduce reject rate, but it also helps to enhance SQ rating of our shoes. We are also giving incentives per pair to our workers. In North America, we are giving $1.35 incentive per pair what they have made. Whereas in Asia Pacific, we are giving 50 cents incentive to our workers. The next part is about workers' compensation. Workers' compensation includes base wage and incentives. In North America, as you can see, total compensation increased from year 12 to 13 from 23,300 to 23,700. Whereas in Asia Pacific, plant compensation didn't change from year 12 to year 13. In North America, total compensation increased due to increase in productivity. But in Asia Pacific, productivity didn't increase as compared to other plants. Now the next part about how many workers we employed. In North America, graph is going up. Sorry, graph is going down in year 13 as compared to year 12, from 395 to 391. Increased productivity required few workers to meet production volume at North America plant. Whereas in Asia Pacific, figure is going up as decreased productivity required more workers to meet production volume in Asia Pacific plant. Thank you. Now I would like to call Mr. Khan to describe about marketing process.
Thank you, Shaoor. Good morning, everyone. Myself, Umair Khan. I'm the marketing manager of Joggers Ltd. I would like to talk about marketing section of Joggers Ltd. Our models offer in 2013 is around 250 models of new design and up-to-date version like new styling, durability of 5-star quality shoes and SQ rating of 5 from year 11 to year 13, which help us to improve our revenue every year. Like in year 12, revenue was 308.89 million and in year 13 the revenue is 338.890 million, which is increased by 30 million. Next is the wholesale and internet price. Wholesale price increased by $1. It is now 49.19 in year 13, which was 48.19 in year 12. Price increased because of increase in advertisement expenses of 3.5 million in year 13. Our price per pair in internet segment remained 66 in year 12 and year 13, but we decreased it from year 10 and year 11 because internet is one of the biggest market. The more you occupied will help increase in revenue, as we can see in our financial results. Our delivery time is 3 weeks to a retailer support of 410, is same as year 12. Rebate offer of $3 per pair is year 12. Increase advertising expenditure to 32 million, which will increase sales volume to 5.902 million pairs in year 13. These are the 5 strategies of Joggers Limited. Will increase more sales in each region by more advertising and price adjustment accordingly. We will maintain credit rating A plus, and we will increase current image rating, which is 70 at the moment. We'll maintain expenditure on a best practice training to increase workers' productivity, which will result in lower reject rates. Furthermore, we'll maximize shareholders' value and higher dividend payout. Thanks so much.